Hey everyone. So I thought I would do a short live update, just to say hi, share a few things that are coming across my screen that I thought would be relevant, and some stuff that's coming up for Bison Insights. So first of all, I'm really excited. One of my friends from growing up, actually, he was a naval intelligence officer who focused on Iran, of all places, for years. Truly brilliant, fluent in several languages. Actually, after he served, he then served less formally as a contractor and so on, and now is actually in the finance space. And so on Tuesday evening at 7:30 p.m. Central Time, we're going to do a live interview and live conversation for Bison Insight subscribers here on Substack. So that's going to be pretty fun. Um, and it was very interesting hearing his perspective. He has a pretty different perspective from the talking heads that you see on TV. And it's super interesting to see sort of who ends up getting airtime. I posted something maybe a little controversial on X a little bit ago about how the folks who were completely wrong, both on oil fundamentals and on oil geopolitical risk coming into this, are now all over TV and selling all kinds of things and top of the list of subscribers and whatever. Um, as if they know, having gotten this wrong so far, like what's going to happen next. And I think the reality is no one really knows, but you do your best to be able to try to figure it out. And um, I think the same things that got you here in terms of understanding the undersupply dynamics and um, understanding supply and demand elasticity and development trends should be helpful in theory for a while to figure out what's next. And I think the big question in the oil market right now is if this is another, um, let's say, October 2024 redux or June 2025, or is this more like 1973 or like 1979? And the difference is, will oil prices collapse shortly, either because Trump tacos, as they say, Trump capitulates, and we end up in some sort of unpleasant settled resolution, or potentially because of a victory from a military perspective, and the Iranian regime falling and a much improved regime coming in, which would be ideal, I think, from a humanitarian perspective and a global perspective, I think. Those would be sort of the downside cases potentially for oil from here, although the longer this takes, the more mitigated that downside scenario is from an oil perspective. And then understanding the potential upside to the extent that this goes on for weeks or months, and as it goes from weeks to months to potentially even longer, what that could mean for the oil market and other commodity markets, and then what that could mean for the stock market, what it could mean for credit. And I'm working on a piece actually on that now. I think my next idea for Bison Insights is going to be more focused on left tail risk here, which could be catalyzed through a continuation of this crisis. Um, and it could be catalyzed by the resolution of this crisis and then people refocusing on the concerns that were present ahead of it. And so I think I found a really interesting way to express a very asymmetric bet, essentially, on this particular issue that's all over the headlines and all over, a lot of focus in various finance corners, as well as on financial media. And I'm excited. I got the idea from a friend who I had shared some ideas with, including, I think it's still the best performing Bison Insights idea. This sort of these warrants on this public company that are very esoteric and weird. So I shared that idea with a friend, ex quant analyst for a giant multi-strat who now is on his own doing interesting stuff, and he shared this idea with me. And now I'm working on presenting it over the next couple of weeks. So I'm really excited about that. And, I'm not so excited that there's this left tail risk in the economy or financial system, but I think it's great to be able to see that ahead of time, and there are some severe mispricings here to the extent that this situation continues. Getting a question: if Trump tacos but Iran carries on with aggression, does oil remain elevated? Absolutely. There are many scenarios with increased probability of higher oil prices for longer. So there is a real risk here, and again, getting back to there are so many folks who are so popular. Like if you go on YouTube, so I do this on a weekly or biweekly basis. I'll just go and see what's trending on oil, what's trending on oil stocks. The reality is that I end up with a lot of subscriber questions and client questions for my day job um, from people listening to this stuff or seeing it distilled through other letters or subscriptions or whatever other stuff that they're seeing and then asking me about it. So it's helpful to sort of see where it's coming from. And some of the same people that just said, hey, this would never happen. There's a really popular newsletter where they said, hey, commodities are dead. They will always go down. Buy gold, which they claimed was not a commodity, and short everything else. And then, of course, now they're selling tons of newsletters talking about what's going to happen next. And it's like, well, wait a second. That was wrong. That was very, very wrong and sort of dangerously wrong and catastrophic from a financial perspective to the extent people followed them. And my hope is that people don't necessarily follow me directly into specific ideas that I share, but hopefully that I'm able to help people identify inconsistencies, obtain valuable information, and then that they can go do their own diligence, consult with financial advisors or whatever they need to do, and then hopefully be better positioned in the markets. But I think part of that is to where there is this just enormous disconnect where literally like the top 20 of these things showing up from financial media and from podcasts and so on are from people who got this completely wrong. And there's almost no acknowledgement of them having got it completely wrong as they're going forward and telling people what to do and what's going to happen next. And it just feels very, very misplaced, and it felt appropriate to talk about that. I got a chance to visit with a large drilling rig company that I don't want to name. They're fantastic, and I'm considering them for investment. I may or may not buy their stock. I don't own it right now. I really appreciate their hospitality and including me in their big investor day this week here in Houston. And um, I got to see their automated drilling rigs, which still require a lot of people, but use a ton of technology and AI and a lot of the sort of stuff that we had, again, this other sort of set of doomers saying, oh, the world is ending because of AI and technology. And you look at a real world application of technology and it's amazing. They are not firing people, even as these guys are probably on the cutting edge of robotics and AI applications and so on. As they incorporate this stuff, they're actually adding jobs and they're finding that they're able to essentially manufacture, and in their case, that's days drilling and so on. They're able to manufacture cheaper and more efficiently, and that's leading to more demand for their products and services. And so, I think this is a quite promising thing to look at. And there is this sort of debate. Is AI going to put all these people out of work, or is AI technology and robotics going to lead to more jobs? And there is a reality. So I'm sitting there in this training rig. I posted a picture of it. Yeah, it's clean, right? Because it's not operating out in the field. It's in in the in the yard, essentially, as they describe it here in the greater Houston area, in an industrial area. So yeah, of course it's clean. Um, Not a ton of mud, and no one's gonna fake whatever stuff. You still have to wear the safety equipment, but and you can't remove it, so it's not like I could take off the hard hat for the picture or whatever. But it was shocking to sit there and use this training equipment, and you sit there and you do basically there's 5 things you hit, and the trainer was saying that there's something like 240 steps that used to be taken by a driller on a rig that are now automated. So the driller does the first few things and then essentially sits there and monitors it. And it's a really sort of fascinating situation because on one hand you say, okay, I mean, my question was, well, why do you need the driller? And the trainer says, no, you're missing it. You actually need the driller more, the person, more, not less, because when there's an error or a problem, you need a person that completely understands the whole situation and can step in, understand what was happening, can control it, and fix whatever it is that went wrong. And so it's sort of like what's happened with pilots, where maybe instead of needing 3 or 4 people in a cockpit, now you have, let's say, 2 on international flights or 1 maybe on a domestic flight. I think they still have 2. Um, and so you need a couple of people who are expert, who are actually more needed now than ever because of potential equipment failure, potential technology failure, so on. Really need to know what's going on, but you don't need 4, and your failure rate's lower and your uptime is higher, and your utilization on this very expensive equipment, so whether it's a plane or now a drilling rig, is higher. And your ability to automate things and to get even better is higher. So it was very interesting. It was not what I expected. I honestly was quite cynical about a lot of rig automation and rig robotics, and it's quite promising. And then the people who are moving off of the rig floor are moving into making sure the pipe is laid out, making sure various other equipment is organized appropriately, preparing for rig moves, preparing for various problems and challenges and so on. And what they're able to do is essentially maintain staffing roughly. And actually, it sort of ends up increasing jobs in certain ways, but maintain staffing, redirect the people, and end up with way higher productivity without losing any jobs, and arguably actually creating jobs through offering more of this service at a lower price per essentially unit of the service, let's say foot drilled or 1,000 feet drilled or whatever, or days of drilling rigs available. But really it's that productivity that goes up so much. That was really fascinating and different from what I expected. And it allows centralized control to some extent, where they have a control room that's able to get a lot more data and a lot of sort of iterative improvements. So very exciting and different from what I expected, and very relevant, I think, for this debate on robotics and on labor. And it reminded me just that I can't remember whether it was Thomas Sowell or someone else similar that I read that talked about this, where um, there's there's 2 ways to look at problems. One is to be a catastrophist and to focus on the negatives and talk about how we won't be able to solve it and capitalism can't solve it, and therefore you need, free money and socialism, and just give up and be despondent. And then the other way to look at it is, hey, there's these fantastic improvements in productivity, and this is going to lead to more of the end product and a safer work environment and more efficiency, and potentially ultimately a lot more product and a lot more efficiency, leading to a lot more potential availability and reasonable price across a number of different inputs, which should lead to essentially more wealth, as well as more jobs created on the back end from the availability and higher productivity. Higher labor productivity leads to wage growth, absent onerous regulations and taxes and so on. So, to the extent that we can keep the regulations in control, which almost all the AI sort of doomers are trying to push for these stimulus payments and direct intervention by the government and all kinds of crazy regulations. And this is just the latest excuse for them on the history of many of these sorts of excuses for socialism. And it always ends the same way, sadly, which is the Cubas of the world, with scarcity and shortages and poverty and oppression. And then there's the other way of looking at it, which is that there's these great improvements, and that technology will likely do what it's been doing for the last hundreds of years, which is reduce manual labor, reduce physical danger of labor, increase abundance and wealth, and increase employment over time through the unpredictable in the precise aspects, but predictable over the span of things, increase in demand through increase in wealth, through increase of availability. And so I think it's really, really exciting and promising, and very, very different from a lot of the doomerism that I've seen in newsletters and in financial media. And that does tie back to my comments on oil, where some of these same folks that are now dooming sort of on the extreme on oil, oil is going for sure to prices where there will be demand destruction across every market, whatever. Um, and here you have WTI oil below $100 a barrel. And should it be higher? Probably. And will it go higher from here? Probably. Does that mean that there will not be gasoline or diesel or jet fuel here in the US? Almost definitely not, other than maybe in California, where the progression of socialism and onerous regulations and crazy taxes and so on have closed refineries and blocked oil drilling until recently. I wrote a lot about this in a few articles where there's one really interesting opportunity in the public markets through all this. But everyone skips that part, right? And they just go right to, oh, well, you need government intervention and you need the government to give up on this program of freeing Iran. And again, whether you're pro-war or anti-war, trying to tilt your oil market analysis to affect the outcome of the war is a little messed up, I think. And as I see more and more of this, and as I went through some of these forecasts and so on, the folks that got it wrong on geopolitical risk, wrong on the fundamentals, are now, it seems, catastrophizing on the oil side. And again, oil prices are high and they're extremely high in certain markets. And there is refined product availability in certain frontier markets right now. But that is more related, from what I can tell, to the cessation of exports of refined products from China than it is to the limitation of oil exports from the Middle East for now. And so, again, this will be an evolving situation. I do think it's really interesting to own certain oil stocks here that are pricing in much lower prices and are incorporating, I think, a lot of the pessimism and doomerism that's extremely popular in financial media, extremely popular in newsletters, extremely popular among many fund managers and so on, at least in sort of their public characterizations. And I just think a lot of it's wrong. And then on the fund manager thing, one of the funny things that I've seen observed across a number of different fronts, and I really like Shrubstack. There, he's active under a pseudonym here on Substack, and he talked about this, how everyone sounds bearish, but they actually own stocks, and then they just, in some cases, own puts, but mostly they just own stocks. And so, when you think about what people are writing about versus what they're actually even doing with their own money, um, it is one of those funny things where you'll see it with fund managers because you can actually see their holdings, the bigger funds where they're forced to file. Fortunately, I don't have to do that for now, so it makes my life a little simpler with my day job. But it is one of those funny things, seeing people say really doomy things and then seeing how they're positioned. And I think one of the things I've tried to do with my Substack, Bison Insights, is to show the performance of the stock and related security ideas from the time that I share them until the time that I close them out, or until whatever time it is that I'm measuring it. And so, why am I saying that? Well, there's a lot of folks, again, that are sort of selling these insights, selling their services, and we don't know how they're positioned in many cases. Hopefully, they disclose their positioning. In some cases, for sure, they're not disclosing affiliations and stuff, which is terrible in my view. And I don't understand how they're able to keep doing it. But I'm not the the securities police, but it seems really wrong. But I think what I can do to address that is show the performance of the ideas that I share via my Substack, and to track it and show the performance of the ideas, both good and bad. There are ideas that I've shared that have underperformed. And I think setting a standard where ideas that I share through this mechanism, where it's controlled, where it's clear, where I've opened an idea, where I've closed an idea, where I closed my first for the first time, one of the now 12 ideas that I've shared, I closed out this week. And I think having that sort of bar of accountability for views that are shared, I think is really helpful in assessing these things. And again, I think it's completely missing, and to the extreme where literally, as you just go down this list, it's like, you missed it, you missed it, you missed it. Well, there was one that didn't miss it that's been out there, which is good. he did miss it on some other stuff where he was like massively long all commodities, and copper's gotten destroyed and gold and silver are getting hit and so on. So there was one exception to this as I went through this sort of comp list. And then everyone else, it's like there's negative accountability, it seems, which is again sort of wild. And you don't you don't have to make it back the same way you lost it, they say in finance, but looking to the people that completely missed it for, hey, what's going to happen next, um, is and who missed it sort of persistently. You had a view in many cases for years, the sort of like nothing ever happens camp. Geopolitical risk shouldn't be considered in oil, which again is like very ahistoric and very wrong from a long-term perspective in understanding oil markets, and just happened to sort of work for a few year period as a sort of historical aberration. Hormuz open, but with an Iranian massive feed of transit. Yeah, that's an example of a scenario that's very hard to see actually play out, and seems more likely as something that's getting floated while US troops are transported to the region, and as more ships are transported to the region, and as a credible threat by the US, or incredible threat either way, um, to allies to try to force more involvement. It is very strange, I will say, to see Japan, for example, negotiating directly with Iran for oil when the U.S. has stationed troops in Japan and facilitated and essentially funded Japan's self-defense for the last many decades. And so I think there's going to be a bunch of changes on the backside of this, and one of those changes could end up being rejiggering of alliances and real significant changes in financial responsibility and troop deployments by the US and others across different parts of the world. For the people who are really worried from a fiscal perspective of what happens with the US attacking Iran, I actually think it's worth considering that, where maybe it costs the US a lot more in the short term to engage in this operation, which is really a war. But on the other hand, if the US ends up with 50,000 fewer troops in South Korea and maybe pulling troops out of Germany and some of these other spots that have not honored their mutual defense alliance and their military alliances with the US, at least not sort of on the face of it. Again, whether the technical things in the agreements, I don't know, but your ally ends up in a war and your supplies are blocked, and then you go and negotiate with their military opponent, that's not in line with, I think, a sort of simple, reasonable understanding of what an alliance is and isn't. And so I think there's going to end up being potentially a fiscal rejiggering, and we might be seeing that right now with gold, where as gold is selling off, maybe it's that the Gulf states are selling their gold in order to fund their defense and war effort and so on. Um, and maybe gold had been sort of in a boom and now is in a bust for, let's say, technical reasons, or maybe people are doing the math and saying, hey, wait a second, yeah, US defense spending and deficit spending is higher right now, but the benefit to the US of higher oil prices, of much higher exported natural gas prices, of the likely boom in industrials from lower energy prices in the US on a much more extreme level than pre-war, potentially continuing for some time. Qatar LNG export facilities destroyed or heavily damaged and potentially offline for years, expansions offline and potentially delayed for years. Maybe there's going to be a really different fiscal situation. Hopefully, there's a different fiscal situation, because we were borrowing way too much money and engaging in sort of wildly irresponsible fiscal policy here in the US. And I think it is actually possible that in the midst of the Gulf states, let's say, selling off their gold, some of that bid for gold may have dissipated from this potential improvement in the fiscal situation. So I'll talk for a second about the big win and closing it out this past week, because I guess that's what I'm. Um, so here, let's see. I'm going to show an article that I put out. Um, that I put out earlier this week. Let's see if I can get this. Okay, here we go. So I put out an article about a it's not a stock, it's a related security, but as I understand it, I had published on a couple of ideas early on that were hard for people to buy. And again, I'm not telling anyone to buy anything, but I got pushback for sharing stuff that was hard to buy. I may still do that at some point in the future, but this was not, as I understand it, hard to buy. People were able to buy it. It was a related security to a stock. I wrote about it early this year and talked about how I thought it had high upside potential from higher oil prices and from just the cyclical nature of the business and it having gone through a downturn. And it seemed likely to me that it could be a 10x over the next few years with the risk of being a zero. And so it's up about well, it was up 279% from when I shared it. And it did go up a little when the article came out, but it was up like 10% or 20% or something after the article came out. So even if one, which again, I'm not encouraging, one were to buy it, even after that relatively in retrospect small move, there was still the vast majority of this return in theory if one were to have bought it, which again, I'm not encouraging or recommending or anything like that. The idea here isn't you should buy this. It's you should look at this and I think learn something potentially from how I'm evaluating this and what went into the investment thesis to understand oil markets, to understand oil and gas investing, and so on from an informational and educational perspective. And so, really fantastic. And I think I've gotten a lot of pushback for a bull. Are you never going to sell any of these things? What are you going to do? Whatever. And that's not why I sold this. I sold this because I think the risk reward changed. But it is, I think, reassuring that there will be things that I buy and things that I sell, I think, for people. I got a lot of notes from subscribers expressing appreciation on this one. And I want to also highlight that this is not a war beneficiary. This thing actually did worse over the time that there's been this war than it did pre-war. And so how could that be? Well, oil prices rose ahead of the US attacking Iran, and oil and gas stocks rose ahead of the war. But also, there were some catalysts that I was expecting, and they played out sooner than I expected, and they led to a dramatic improvement in the price of this security after I wrote about it. And so it was fantastic. It was almost awkward in terms of how quickly it worked versus when I wrote about it. But, it was there. It was liquid enough for folks who wanted to own it. Um, and it was great. And so I don't think that I will be able to replicate this. I think that it is unreasonable to expect that I will find another idea that will go up 276% in just a few months. I think that's very unlikely, and I hope that no one expects that. But what I will say is, I think that I've shown an ability to find stock ideas and related stock ideas related to stocks that can materially outperform. I think I've shown that I'm very honest in terms of the performance of the ideas that I share, as you can look at this chart and see idea number 8 has lagged a lot. Idea number 12 has done poorly, and it's actually down more versus when I shared it. And idea number 3 has now underperformed a little, although I love it and think it's fantastic. And I'll probably, I may end up buying a lot more of it at some point soon. But I think the important thing is honesty and integrity, and also understanding sort of what is going on with Bison Insights and what isn't. And so what is going on is that I'm sharing ideas that I find compelling. Most of them have materially outperformed versus the broader stock market and versus oil and gas stocks. They've outperformed versus, in this case, this was a services related idea. And so it outperformed versus XOP, which I'm just using as the benchmark for all ideas because I'm sharing oil and gas focused ideas. But also, I got asked this, hey, how did it do versus oil services stocks? And this thing massively outperformed versus oil services stocks. And it outperformed even more versus the broader stock market. Similarly, from the time I shared it until the time I closed out the idea, this massively outperformed versus XOP the broader sort of oil and gas stock index that isn't overly weighted just to Exxon and Chevron like XLE is. So I like it a little more as I think a little better indicator for the oil and gas industry and oil and gas producers broadly. And then even more so versus the specific subsector that it's in this sort of OIH services index. And then even more so versus the broader stock market. Again, past performance may not be indicative. The goal of this is not to say, hey, sign up for my Substack because you're going to get a 276% return on the next idea. That's not that at all. What it is that I think that there's some unique elements to my investment process, which is relevant for me for my day job in running an investment firm. And my goal has been to share some of the unique aspects of my investment process via this newsletter for people to better understand it and for folks who can't or aren't interested in being involved with a investment firm that is only available, only allows investment in large size from accredited and qualified investors and institutions and so on, to be able to benefit from some of the ideas that I'm generating, that I'm able to share. And so so far so good, I think, for that. And but not perfect. And a few of these ideas have underperformed. And I would expect that probably on the next 12 ideas, a higher percentage would underperform than this set. And I would expect that the ones that outperform in the next 12 ideas probably won't outperform by quite as much as the ones that did outperform of this current set. That being said, I'm very proud of the performance that's been achieved by these Bison Insights ideas. And I'm going to work really hard to share other ideas that will do as well or better, which again, you should not rely on and I cannot promise and shouldn't expect and so on. So I thought I'd walk through that just for a little bit. I do think it's really important to highlight that. And then so I have this thing up on the wall that my friends made me. It's a little awkward to have a picture of myself. I sort of don't like that part of it, but I was in Barron's in 2022. And it's maybe a little hard to read because it gets flipped or whatever. But this shows that my investment firm, we were up on a gross basis almost 400% in 2021. And again, past performance is not indicative. This is not an offer, solicitation, or recommendation. That's not why I'm sharing this. We were up a lot. It was great. We got a lot of questions. How'd you do it? What'd you do? How's that even possible? How did you outperform the next highest performing energy investment fund by 100%? The next best one was up like 180% or something in 2021. And so what it was difficult to answer that. And I started to share one-off investment ideas publicly, got a lot of flack for it. Hey, what are you doing? Why are you doing that? Why would you, if it's so good, why would you give it away, etc.? And so the the idea here isn't to it's definitely not to raise money for my investment firm. It's completely separate. And I disclose where I have ownership. I've owned all of the ideas that I've shared. Most, if not all of them, my funds I advise have owned. But the goal isn't through this to raise money. It's to highlight this process that I used in 2021 to generate this astonishing return, which again may not be indicative. Past performance may not repeat itself. However, it's helpful if you think that you're going to do really well, which I was very optimistic that oil stocks would go up a lot, to the point where a lot of industry folks, I think, got upset and felt like it was inappropriate to be excited about oil and gas, which again was very promising to me. Very weird pushback, but everyone's so despondent, still despondent to a large extent, which is wild. And I was right. And I think that we're going to see some of especially these smaller oil and gas stocks, not all super small, but smaller than the Exxons and Chevrons and Schlumbergers and whatever of the world. I think we're going to see them materially outperform. And there's no guarantees on that. My crystal ball is broken, but I think, and I wrote about this extensively, both for the investment firm and repeatedly on Bison Insights, showing many different indicators interviewing different experts in insider buying, in oil and gas governance and management, in quantitative analysis, CEOs and CFOs of very high performing companies where their stocks weren't yet reflecting, and still, in my view, aren't yet reflecting their intrinsic values. And I think that we have a shot to replicate the sort of success as investors in small cap oil and gas companies that was achieved in 2021 and to a lesser extent in 2022. I think there's a shot. There's no guarantees. There's lots of risk. There's lots of uncertainty. And my thought was, hey, if I think that's the case, I might as well go show some of my favorite ideas in the process, share them with folks who cannot or will not invest in my investment firm, which is fine. And just sort of be a little bit more open as this plays out. There's lots of benefits for me. It's a paid subscription service, so I get money, which is nice. And it's also really nice to share stock ideas in one specific spot. So when as a part of that record, I shared a stock idea on TV. It was 20 cents or something a share. It went to $5, and then it went bankrupt eventually. And so I still get a lot of flack weirdly on social media for that. Um, if you see an idea that goes from 20 cents to $5 and you get mad because it then goes down, I think that's a you problem, not a problem for the person that shared the idea. It was phenomenally profitable for me. I was able to exit the position, or at least a bulk of the position, at really attractive prices through risk management. Even as I was excited about the idea, it was possible to go own own it in lesser size as the risk reward changed as the stock went from 20 or 25 cents up to $5. And similarly, I think there's the potential for a number of these different companies and related securities to outperform significantly, as some of them have. And again, just because some have doesn't mean that others will in the future. There's no guarantees. And I can just keep saying that, and people still think that this is somehow implicit guarantee. It's not. Um, I do think it's helpful to sort of show this as it's going and to help people understand understand how to do it, how I did it. And the reality is that as I share that, most people won't do it. Most people won't even sign up for it, and they'll miss it. And that's fine. And they'll be really interested, I think, in a year or two after there's hopefully, but no, don't rely on this, many more of these 3 or 5 or 10x type companies that returns achieved and so on. And again, I can't promise that, but I'm optimistic about it. It's like why I'm doing this. And then they'll be interested. And at that point, in my view, after these things reprice materially, they get much less interesting, and I will be a seller, not a buyer. I did get a little pushback from some folks who were very optimistic about the company that I exited after a almost 300% return in under a year, saying, "Hey, there's more there." And my answer on that, and my answer in the future will be, "That's wonderful. I hope you're right. You may enjoy that return. I'll enjoy the return where I see there being a compelling risk reward, and I'll suffer the consequences where I'm wrong." And so, so far so good. It's been fantastic running this Bison Insight so far. There's a lot more to come. Again, like I talked about at the beginning, I'm really excited. I'm going to get to interview a retired or sort of former Navy intelligence officer to get to talk about what's going on in the Middle East and the different scenarios of how these things could work out and end, and what it might mean from an oil market perspective and for other markets. So it's really great. Oh, this is fantastic. Yeah, I get these sorts of questions all the time. Would living in Calgary let me meet more management teams and give me an edge? Houston is the energy capital of the world. Calgary is a regional hub where there's a modest number of oil and gas companies headquartered. Uh, the the numbers are astonishing. I think it's something like 10 or 100 or something times the market cap based here versus Calgary. Many of the Calgary based oil and gas companies Their senior management come here regularly for investor meetings, for meetings with their partners to try to do joint ventures or asset sales or whatever. Houston is very much the energy capital of the world. I think if you're in Calgary thinking, hey, this is the center, I mean, it's just the math isn't there. So it's great. And there's many great people and great companies and service providers and so on that are based in Calgary, but it is a regional hub, not sort of the center. The place to be if you want to be in oil and gas, in my view, from a management perspective, from an investment perspective, is very much Houston. And then if not Houston, then Dallas Fort Worth. And if not Dallas Fort Worth, then I think it's an open question of Denver, Calgary, Oklahoma City, some other places. But just again, just by the numbers, you look at the market capitalizations of the companies, you look at the available funds and so on, fund sizes and so on. You look at the giant firms, the giant investment firms, and look at sort of where they put their investment offices and the international companies where they put their sort of North American offices. Even a lot of the companies with, let's say, Latin American or South American operations and so on, they're here for the most part. They might even be listed in Canada, and they'll still have a bulk of their operations here and or in their sort of local jurisdictions. So no, I think Houston very much is the center for oil and gas, and if anything, I think trying to be, let's say, a globally focused or even a North American focused oil and gas investor and not being here, I think, is a pretty significant disadvantage from what I see and experience. Again, there's just tons of inbounds on management meetings, on asset visits, on whatever, and just not. Just from the size of things, it's just not even comparable. I guess another way to look at it would be, Canada produces something like 4.5 million barrels a day of oil and liquids, and the U.S. produces 22.5 million barrels a day of crude oil and liquids. So it's just a tiny fraction. And again, even smaller when you look at capitalization and other operations, giant refinery complex here in the US, but also in the Houston area, giant chemicals complex here. There's just so much going on. And you could see even, it's been helpful. I'm just going to the beach at Galveston or down further south. If you take the main road down to Galveston, you see some of it by the Houston Ship Channel, but down by Freeport, the amount of expansion and getting to just see the various operations springing up. Some of the stuff actually moved from Europe right off that highway. They chopped up their facilities in Europe and moved stuff just what is it, off the 288 or something like that, going down to the beach. So even just recreationally being here, you end up seeing a whole bunch of chemicals and refining and oil and gas stuff. So it really is truly a center. I moved here from Los Angeles, which is where I'm from, and I moved to Houston in 2016. And part of it was for better regulatory environment and taxes and so on. But a big part of it was availability of access to management, getting to sort of naturally meet various folks across the value chain in oil and gas and energy, as well as in related industries. And it's fantastic. A lot of my close friends are in the industry, and they're great people, and I'm friends with them because they're great people. But it's also very relevant and helpful to surround yourself with the thing and the things that you're trying to understand very well, and where there's a zero sum, essentially, competition with other folks to understand it better. Bullish on specific oil stocks. I get this all the time. I don't love exposure to ETFs in oil and gas. I actually started my investment firm in 2015 because I looked at these structural problems with the exposures of these different ETFs. And I said, I don't like this. I don't think this is a good solution. And I started it actually with a partner. We co-founded the firm to essentially go to endowments and pension funds and foundations and so on and say, hey, you guys are invested in XOP or XLE or PSCE, these different ETFs, or sort of through passive managers that would sort of reconstruct the ETFs and optimize for taxes or whatever for them. And or optimize on certain other fronts. And hey, you guys are doing this. We can see it. You have X number of hundreds of millions of dollars here. Pay us a percent of the profits above what you would make on this stuff, but we'll just go do this for you and we'll do it better. And we'll do it through picking stocks. And we got laughed out of the room in most of them. One of them, through a close relationship with a great guy, we ended up getting in front of, and they ended up allocating, and it was great. They invested with us for a number of years, and even after that, so we thought, okay, so they'll they'll come around, these other endowments, and they just thought this one endowment was stupid. And so, just to provide context, and again, I'm sharing these numbers to highlight my view of the inadequacy of oil and gas ETFs, not to and I think the promise, actually, even for Bison Insights, we can just look at the performance of Bison Insights ideas so far versus XOP and similar ETFs. But the investment firm that I launched as this alternative, again, not an ETF format. I wanted the ability to sort of not have to disclose positions as I was building them or selling them or so on. So the private investment fund format for this solution seemed strongly preferable. It's part of why I haven't launched an ETF. I think there's a real advantage in not doing that. And what I found was that it's now been almost 11 years. We're coming real close on 11 years. And in those 11 years, just put out numbers through end of February, so pre-war, the PSE small cap index, I still think small caps end up way outperforming. We'll see. The PSE small cap index, it was down 56%, that ETF, from when we launched in May of 2015. And we were up something like 145% net of all fees, expenses, everything, including a significant incentive fee. And so the gross is higher than that, but not really relevant because that's not what's delivered to clients. And again, this is not a solicitation. I'm not sharing it to ask for money or whatever. I'm sharing it to highlight my problem with the ETFs. And the last times I've done this, people say, oh, you're stupid, like over this 2-month period, at whatever. Great. If you're trading these things for 2 months and your crystal ball is better than 99.9% of day traders who lose money day trading stocks, wonderful, congratulations. You should have a trading fund or something. But that's a very, very difficult negative sum game to try to time those sorts of things. The construction of the ETFs was problematic. The performance of the ETFs has been abysmal. When we go up to XOP, I think it's down 11% since we launched in May of 2015. Virtually 100% of the assets were either in cash or publicly traded oil and gas companies. There have been a very small number of privates, which were not material return contributors and only started in 2021, I think. So almost entirely just directly comparable to these ETFs. So I do not like the ETFs. They may outperform. I do think that the PSEs of the world should outperform over time. These small caps should be able to do a lot better, similar to how like GDXJ, which was also very imperfect, massively beat the market over a multi-year period when it went from being hated to being loved. These stocks are still not loved. I think there's a similar move potential for PSE. I just think that there's much more potential from these individual stock ideas. And you can get access to a lot of my favorite ones just by paying like some tiny amount versus what investment management fees cost or whatever, and just sign up for Bison Insights. It's very simple and cheap, and it's, in my view, strongly preferred. And my professional track record, I think, speaks to the ability to, with risk management and careful position sizing and so on, materially outperform these indexes. And again, I'm giving people the tools that I use essentially to be able to have outperformed them. And just because I did for 11 years doesn't mean that I will in the future. But at some point, when you outperform for long enough by a large enough margin, hopefully it's promising for the ability to do that in the future, while again, it is certainly not guaranteed and may not even be indicative. Does the Middle East receive capital from Houston? Yeah, I don't know. I mean, I think Houston's been sort of a capital hub. I think CERAWeek is coming up this next week. I never go to it. It's sort of this like weird gathering of folks. It sort of reminds me of these pundits getting on TV and just being wrong all the time. CERAWeek was like almost 100% dedicated to renewables and whatever for a few years. And now magically they're like the oil center again. I don't know. I like Nate, which is oil focused. I need to get an invitation to Thrive for next year. If anyone from them, Daniel, listening, I'd love to check that out. I like the oil conferences. I'm going to go to Enercom again this year. I like those guys. They're just very consistent. Yeah, do they have a little bit of renewable stuff? Sure. Is there a future in that? Probably in some fashion at some point. But I like the oil conferences. I like people that are focused on the thing that they said that they would focus on. And when I look at the enormous capital destruction by the BPs and Shells and even the Exxons and Chevrons and so on of the world, who malinvested tons of money into stuff to look pretty and to assuage angry shareholders, and then just suffered giant, in some cases, multi tens of billions of dollars capital losses. I think the overall losses might be in the hundreds of billions of dollars across the oil majors and sort of other sort of energy sector in renewables and so on. I just don't like that, and I don't think it shows well for the folks that sort of pivoted to those renewables and then are pivoting back to oil. Like I think it displays a lack of seriousness and credibility, and similar to the oil pundits who were just completely wrong for years, saying, fade geopolitical risk. You see political risk, sell it. It's not real. It doesn't matter. It won't impact things. Completely ignoring, if you look at the long run price history for oil and supply dynamics for oil, a big part of the industry beyond inventory depletion and discoveries and so on, a big part of it was oil geopolitical risk, and I don't think it was reasonable to ignore that history. And so for the folks that were ignoring it, were telling everyone to ignore it, said that repeatedly for years, in many cases emphasized that geopolitical risk was not part of their process in evaluating oil markets, and now are sharing their thoughts on oil geopolitical risk and oil markets. It just seems misplaced and is not something that I can take too seriously, and something I think I'll probably be increasingly vocal on because of the ridiculousness, and I think actually a little bit of hypocrisy on that. Strength of the U.S. dollar plan to my investment thesis. The U.S. dollar being strong versus Canadian dollar has helped profitability for Canadian companies. In some cases, they're so wildly profitable that if the Canadian dollar swung 20% or so here, it almost wouldn't matter. That's actually one thing where the ETFs, I think, are messed up. The valuations matter a lot for these companies. And so there is a tendency for momentum to continue in stocks in the short to medium term. But over time, valuation matters. If companies are not earning a high enough excess return to justify their higher multiple, there is a powerful mean reversion in commodities. And I don't short stocks anymore because I lost a lot of money shorting stocks a while ago at a prior entity that failed because I was bad at shorting stocks, among other things. And that being said, it is somewhat predictable to see what's going to happen in the long run with some of these companies. It's just one of my problems with shorting them is I'd identify it and short it, and then have trouble managing the short as the stock would go up, as like momentum would continue beyond my reasonable, or anyone's, I think, reasonable expectations. So these things that are very highly valued could continue to go up for a period of time, but I think carefully underwriting companies, owning them at large discounts to a reasonable estimate of intrinsic value, to me seems like a strongly preferable approach. And I'm just going to keep doing that. So that's part of why I like individual stocks and related securities, because I like to be able to underwrite them and find the ones that are best in my view. And then that's part of why I don't like to buy the sort of market darlings that are overhyped and everyone's sort of talking about and whatever. And again, over short time frames, that can get a lot of flack. And there's a lot of, I think, this sort of like negative feedback loop on social media, where there's a lot of people that are either that were laid off by the industry, or sort of stuck in back office jobs, or sort of very frustrating jobs, where they're very angry about that. And so they find these companies they don't like, or people who are positive on the industry that they don't like, and sort of have this like self-reinforcing pessimistic loop that, I mean, I guess it makes them feel better or something, but it's not profitable. And actually, it's actually been sort of helpful in finding potential investment candidates where it's like, hey, okay, everyone has decided that XYZ company is so terrible. Cool. Okay, let's look at it and see, is it so terrible? And in many cases, it is. But in some cases, there are fantastic companies or fantastic assets that are obscured by bad capital structures, by a negative history that's less relevant for some reason. And I think using a value and deep value type approach to investing is actually particularly promising in an environment where there's so much emotion and negativity and such a sort of tough history over the last 12 years or so for the oil market and for oil related securities. Anyway, with that, I think I'm going to wrap this up. Again, none of this is meant as an offer, solicitation, or recommendation. I would love for you to sign up for my newsletter, bisoninsights.info. And I would appreciate it. And so far, a lot of these ideas have done great, which doesn't mean that they will do great in the future, but so far so good. Closed out my latest closed out for the first time one of these ideas at a huge gain, which again does not promise that others will have a huge gain, but at least is, I think, reassuring that I will close out ideas where I like them, where the risk reward has changed and where I no longer like them. And I'm really excited about the next idea that I'm sharing that I think may be even more broadly relevant to readers than some of the ideas that I've shared. And really excited about doing this interview of this naval intelligence officer, now retired, who focused on Iran. And that's going to be at Tuesday at 7:30 p.m. Central Time here on Bison Insights. With that, thank you very much. Have a great day. Have a good weekend. Take care.